So we're talking about the technical and fundamental analysis of foreign exchange rates. And one concept that we haven't talked about yet is why do we do this? What would be the exposure of a company to foreign exchange rates? And as you can see, by the way, I have the dollar euro exchange rate in front of me, and we have the 200-day, the moving average, and today the dollar is slowly losing value, slightly. But notice how, when we talked about the mean reversion, notice how for the past couple of weeks, the dollar has been, slowly but surely reverting to its mean. But again, the idea is, why are we talking about this? What is the point of, um, trying to predict foreign exchange rates? So to begin with, um, why is it that, or do we want the companies that we invest in to hedge their foreign exchange risk or to hedge their commodity risk? Like, for instance, if you invest in American Airlines, for instance, would you want the company to hedge against the value changes, price changes of the oil? If you're investing in a company like, say, Kellogg, uh, would you want the company to hedge against the price changes of commodities? And the answer seems so obvious that why not, right? I mean, we want the company to invest in, or say Procter and Gamble. I'm not sure why the Kellogg didn't come up, um, but why wouldn't we want the company to hedge against the uh, commodity prices? That would make our stock price to be a lot more stable and perhaps a little bit less susceptible to changes in commodity prices or the foreign exchange prices. So the hedging seems to be the obvious uh, choice and obvious preference of investors when it comes to hedging against commodity prices that our companies are most susceptible. And same thing goes for exchange rates. Why wouldn't we want our companies to hedge against the foreign exchange rates? Why do we just want them to predict? And again, I want to emphasize the difference between hedging and prediction. What we're trying to do is, our job is to show you the two separate, actually, worlds. On one domain, you have the forecasting and prediction and trying to navigate your company based on that forecast and prediction and compete and exist within your sector. On the other domain, you are hedging against any changes in the commodities that you're dependent or in the currencies that you are susceptible to, that you have an exposure against. So these are two separate things. If you're hedging, then you really don't need any sort of forecasting. You don't need any sort of predictions as to the commodity prices or the foreign exchange rate because you're hedging. You can hedge with futures and forwards and options. And we had examples in the past weeks. And once you hedge it, you really are all done. So think of it like, if you are, going back to the example with American Airlines, if you are actually hedging against the prices or price changes of the oil, then, as a company, no matter what happens in the oil prices, you would be immune from that, from those changes. And that seems like the best thing to do. Also, say for a company like, say, Exxon, I mean, you are an oil company, and I'm sure that they actually have significant, um, you know, futures activity, but wouldn't it just make sense to hedge against the price changes of oil? That would make the stock price a lot more stable. However, from an investor point of view, um, I personally wouldn't want my company to hedge because, you see, when I want to take advantage of my expectation of higher oil prices, then I will buy Exxon. And if I have a expectation of oil prices going down, then I will buy companies that are that oil is a significant cost, like American Airlines. So my expectation as an investor will determine what type of company that I want to invest in, and therefore I don't want these companies to hedge on their own. In fact, if I wanted to be immune from, or if I wanted to have, a little bit more stability in my portfolio against commodity prices, I might include companies like American Airlines and Exxon and other companies that the stock price may be, dependent on the commodity prices, and I might try to hedge myself within my portfolio. But if the individual companies hedge themselves, then what will be the point of investing in these companies with an expectation of a commodity price change? Meaning, if I expect oil prices to go up and then I invest in Exxon, but if Exxon was hedging itself against oil prices, then if oil goes up, nothing would happen to Exxon, and that would be disappointing to me as an investor, because that's why I wanted to invest in Exxon to begin with. And also, there's always that discussion of competition. You have Exxon, and then you have Chevron, you have American Airlines, and then you have Southwest or United or whatever. So the idea is that when one company hedges and makes the stock price stable, it may be that we do not have that volatility, or that we may not have that competitive advantage of one company over the other. So if if American Airlines were to hedge, and Southwest is not hedging, and oil prices go down, then Southwest will be at an advantageous point, simply because they will take advantage of the cheaper oil prices and they will make their ticket prices cheaper. Whereas American Airlines hedge themselves, and no matter what happens, their oil prices, the stock price won't change, but they will lose their competitive edge against the Southwest. I mean, obviously, when the oil prices go up, then American Airlines will be at an advantageous point compared to the Southwest. So similarly with Exxon and Chevron, if they were to start hedging, they lose that point of whether they should, or they lose their competitive advantage when the underlying commodity price change. So that's the main difference between the hedging and then not hedging, and then forecasting, right? So we do the forecasting because we choose not to hedge, and we want to see, or we want to prepare for what is to come. And it actually makes us more competitive with our competitors, and we could take advantage of prices that work in our favor. On the other hand, when we have in a hedged position, then we're immune from changes of the underlying commodities, and that's a good thing. But then again, we lose our competitiveness with respect to the commodity prices that we're dependent. So again, I want to emphasize in this video the difference between why we hedge and why we take the exposure and try to predict, try to forecast. So, well, for this short video, this was the point. So let me know if you have any questions, and thank you for working with me. And thank you so much. Bye now.